Everywhere you look, there's a new promise of effortless wealth. Set your risk level, answer a few questions, and an algorithm will handle the rest. Diversified, optimized, tax-aware, for a low fee, for everyone. It sounds like a revolution, but if these systems really make the average investor smarter, richer, more secure, why do the average results still look, well, average? And who benefits most from this newfound efficiency? The person saving for a future, or the machine that quietly manages them? A century ago, investment felt like art wrapped in superstition. People chased tips, trusted insiders, and treated markets like a casino where luck could be summoned by charisma. Then, a quieter idea took hold. Perhaps risk could be engineered, not conquered, but arranged. Diversification moved from folklore to formula when a young economist proposed that a portfolio could be treated like a single organism. Mix assets that don't move together, and the whole becomes sturdier than any part. The idea matured into a doctrine: don't pick stars, own the sky, own the haystack, not the needle. The index fund arrived as a practical machine that let ordinary investors buy the market instead of a handful of stories. Fees dropped, frictions fell, and the old priesthood lost a bit of its mystery. Fast forward, and the doctrine turned into interface. What once lived in academic journals and dusty calculators now lives in an app with a soothing color palette. Algorithms take the old ideals, diversified exposure, regular rebalancing, cost control, and automate them with religious consistency. The sales pitch is simple. Technology has turned good habits into defaults. The subtext is simpler. The system will be fine if you do nothing at all. Sit back, we've got it. Automation here isn't magic. It's plumbing, a set of pipes that move your money into baskets of broad market funds, rebalance the mix when one basket overflows, harvest losses for tax purposes, and send occasional push notifications that sound like Stoic philosophy. Under the hood, it's not alchemy, it's engineering, admirable precisely because it isn't exciting. But the moment excitement returns, when screens bleed red and the news smells like gasoline, the machine reveals what it is and what it isn't. It is discipline you didn't have to build. It isn't a guardian that knows your limits, your job prospects, your mother's medical bills, the feeling in your stomach when a conservative bond sleeve drifts down in double digits. It is rules. You are the human who must live with them. Start with the ritual at the entrance, the questionnaire. It asks how you feel about risk, offers a few scenarios, and translates your answers into a target mix. Something like 80% stocks, 20% bonds if you're young and brave. A gentler balance if you're cautious or close to retirement. It feels scientific because it wears the language of science. But these are snapshots of your mood, not x-rays of your soul. Answer on a calm day and you are a Spartan. Answer after a crash and you're a monk. True risk tolerance is not how you answer a survey. It's how you behave when the market tests your biography. An algorithm cannot know that until the moment you and it discover it together. Then comes allocation. A basket of ETFs gives you exposure to domestic equities, international equities, emerging markets, real estate, and bonds. Sprinkled in, perhaps, are factors with names like value or momentum that promise a little edge for a small fee. On paper, this looks like diversity. In practice, crisis compresses difference. When fear rises, correlations often sprint toward one, and your many baskets reveal themselves as a single vessel painted in different colors. The pie chart promises separation. The storm reveals a flotilla roped together. Rebalancing is next. As one asset surges, the machine trims it and tops up laggards, so the portfolio returns to its ordained weights. It is the ritual of buying low and selling high, without the pride that usually ruins that sentence. This habit is old and sensible. It also contains a hidden assumption that deviations from the target are noise around a stable mean. But regimes change. Sometimes the world is not wobbling around in equilibrium. Sometimes the floor itself has shifted. Rebalancing will still do its job, because code does not get philosophical, but you will feel the tension between the elegance of the rule and the chaos of reality. The machine's calm is not the same as your comfort. Then there is tax loss harvesting, the neat trick of selling positions that are down, recording a paper loss, and immediately buying a similar but not identical fund to maintain exposure. The loss offsets gains elsewhere. Tax bills fall. This is clever, legal, and often valuable. It is also a deferral, a dentist appointment move, not canceled. Future gains will meet the taxes you politely postponed, and your actual benefit will depend on the path your life takes. Income next year, jurisdiction, estate plans. The algorithm knows the rules. It does not know the lives that change how those rules bite. Finally, the nudges. The device pings with short wisdoms. Stay the course. Time in the market beats timing the market. Volatility is the price of admission. These reminders are more than marketing. They're behavioral guardrails, and they might be the most genuinely valuable service in the entire package. If a calm sentence keeps you from selling a lifetime of compounding at a discount to your own fear, it has earned its fee. Yet even here, a paradox lurks. The machine that saves you from panic is a business that cannot panic. It needs you invested. Your fear registers as a ticket, not a conversation. If you want to understand something, follow its incentives. The platform earns a percentage of the assets it houses. That means every additional dollar you deposit, and every day it remains under their roof, is a small stream of rent that never sleeps. The safer business is not predicting markets, but predicting human inertia. The fund providers who sit inside the platform want flows to stay within their family of funds. ETF A and ETF B might be cousins. When the algorithm rebalances, the family keeps the reunion in-house. Regulators are not villains in this story. They prefer standardization to idiosyncrasy. A world where millions hold similar diversified pies is easier to supervise than a world of handcrafted contraptions that blow up in private. The risk is shifted from household explosions to systemic correlations that only show their teeth when everyone sprints the same direction. And for the user, a quiet incentive whispers, outsource thinking, outsource blame. If the plan was sensible and the rules were followed, the pain feels less personal. Sometimes that's healthy. Sometimes it's anesthesia. Nothing in this arrangement is inherently sinister. But it does tilt the playing field toward a particular outcome. Assets that sink into a diversified inventory and seldom leave. Fees that drip with metronomic reliability. Portfolios that look strikingly similar across millions of lives. When the tide is rising, this order feels like wisdom. When the tide falls, sameness becomes synchrony. That's the trade. Efficiency for individuality, automation for agency, the average for the promise of averageness delivered. The decade that raised these systems from clever startups to household names was generous. Interest rates declined, liquidity flooded, valuations climbed a long staircase, and central banks stood ready with hoses every time a spark appeared. In that world, the algorithm's habits seemed like genius. The market crashed, rebalanced, and roared back. The loss harvesters had a feast, and the optimizers patted themselves on the back. But generosity has a way of creating complacency. When inflation stirred, bonds reminded everyone that safe is a context, not a guarantee. A balanced portfolio that had not looked risky for years suddenly felt like a carnival ride with a safety bar loose. The rule set did not break. It met reality on different terms. Moments of stress reveal a subtle second-order effect. When a large share of investors hold the same instruments for the same reasons, flows can become synchronized. During calm periods, synchronized flows dampen volatility. Regular contributions by the same broad funds, rebalancing sells winners and props up losers, and the machine hums along. But in a sudden shift, an interest rate surprise, a liquidity freeze, a geopolitical shock, the exit can narrow. If the same rules trigger similar trades across millions of accounts, the market behaves like a crowd trying to leave through the same door. It eventually clears, but for a time, price becomes a conversation conducted at a shout. Even this isn't a condemnation, it's an observation. Industrialization brings scale and stability, and it also brings monoculture. Monocultures are efficient right up until the blight. So what are the promises? Some are real and durable. Lower costs are not a marketing slogan, they're arithmetic. A basis point saved every year compounds into meaningful dollars over decades. Automation of sound habits, periodic rebalancing, automatic contributions, sane tax management, removes the frictions that wreck amateur plans. Behavioral coaching by push notification is unglamorous, but if it stops you from buying high and selling low, it's a quiet hero. Most importantly, access matters. A teacher with a small account enjoys institutional-grade plumbing that used to be reserved for large family offices, and that shift is a kind of democratization. But some hopes will always be illusions. A market portfolio cannot deliver more than the market to the crowd that owns it. If the baseline is the average, the expected outcome after costs is average minus the costs, however small. That is not a bug, it is the philosophy itself. The pitch whispers liberation, the result is standardization. You receive the broad deal that markets offer across decades, sometimes cruel, sometimes generous, always indifferent. Costs hide in culture too. Outsourcing removes bad decisions, and it also removes learning. People who never look under the hood of their own portfolios are calmer until they need to make a novel decision. When to draw down, how to adjust after a job change, whether to fund a parent's care or a child's education, and discover they've built a body without muscles. Data becomes a quiet currency. Risk scores, balances, spending patterns, deposit timing, all of it forms a profile that can be used to improve services and also to sell them. Customization often becomes theater. Sliders and themes give the feeling of tailoring, but the skeleton remains the same handful of broad funds in varying proportions. And horizons drift in a way no algorithm can foresee. Life is not a straight line. The code knows your age. It does not know that you will move across the country in 2 years, change careers at 46, or that your partner sleeps badly when the portfolio is down 10%. None of this argues for abandoning the machine. It argues for understanding the machine well enough to use it on purpose. Begin by choosing a philosophy intentionally. If you want market returns, the price is market drawdowns. Do not pretend discipline is painless. Set that expectation when the waters are calm, because you will not negotiate with yourself successfully during a storm. Know what you're paying and to whom. A platform fee stacked on fund fees and small frictions can turn almost zero into something that drags on the quiet compounding you never see. Count behaviors, not tickers. If every component is a rules-based fund tracking a cousin of the same index, your pie chart might show many colors while the underlying circulatory system beats in unison. Stress test your own stomach with arithmetic, not imagination. Look up the worst drawdowns for portfolios like yours and then double the number in your mind to account for the possibility that the future will be less kind. If that imagined pain makes your pulse quicken, the time to lower risk is now, not in the middle of a spiral when you will sell the plan and the peace of mind at the same discount. Think of taxes with a calendar instead of a slogan. Deferring a bill is fine. Orchestrating when you'll pay it is better. Future income, jurisdiction, charitable intent, all can turn a clever trick into a comprehensive plan. Automate the inflow, humanize the outflow. The machine is brilliant at moving money in on schedule. When life forces money out, bring a human conversation back into the loop, because sequence of returns risk is a silent thief that shows up precisely when you feel vulnerable. Write your own behavioral contract in one page. When the market falls by X, I will do Y. When headlines scream, I will do Z. Algorithms have code. You need code too, and it must live somewhere sturdier than a mood. Most importantly, honor the things the machine cannot know. It does not understand that your income is tied to a cyclical industry, that the local housing market is a bubble, that your spouse says she can handle volatility until she sees it. It cannot coordinate risk across your whole life. Career risk, geographic risk, health risk, leverage in the real estate you own, the implicit bet embedded in your company stock. Consider the system a spine for your savings, not a full nervous system for your financial life. Some will insist that none of this matters, that history shows the market always recovers and you need only endure. That statement is statistically correct and psychologically incomplete. People do not live in 40-year rolling periods. They live in seasons: a baby born, a job lost, a parent ill, a home purchased, a city burned. In those seasons, the average result is an abstraction. The lived experience is cash flows, timing, and stress. Algorithms cannot eliminate human nature. They can only move it off screen until the screen turns red. It is tempting to ask who wins. The answer is mundane. The guaranteed winners are those who collect basis points on other people's assets. The platform that skims quietly on every dollar. The ETF brand whose products line the shelves. The institutions that transform mass inertia into a reliable revenue curve. That isn't a scandal. It is a business model. The ordinary saver wins when the tool helps them avoid the big, classic mistakes. Panic selling, overtrading, expensive advice, undisciplined timing. If automation keeps the worst impulses sedated and the contributions flowing, it has more than paid for itself. If it dulls awareness to the point where risk becomes an aesthetic rather than a number that can hurt you, it's a velvet trap. Behind the product lies a deeper cultural shift. For a century, finance has been a story of removing humanness from the levers. Risk, once intuitive and local, became an equation. No. Trading, once a face and a shout, became a matching engine in a basement. Advice, once dinner table and trust, became content and interface. Robo-Advisors are not the beginning of this arc or its end. They are the consumer face of an industrial system, whose premise is that average can be manufactured at scale, and in many ways that's progress. Average used to be reserved for the patient and lucky. Now it can be had by anyone with a smartphone and a bank account. That is not a punchline. It is a powerful leveling. But a system designed to deliver average will deliver average with exquisite precision. If that's what you want, embrace it fully. If you want something else, know that the machine will not help you find it. To seek anything beyond the market, broad bargain requires either skill most people don't have, patience most people won't maintain, or an edge that cannot be mass-produced. The platform will not sell you a product that promises what it cannot provide to everyone. It will sell you what it can deliver to everyone. An orderly ride on the market, this long train with a small toll charged at every station. That is, in truth, a better deal than most of history offered. The line between liberation and dependency is thin. Automation can free the mind for better things, or it can atrophy the capacity to act when action matters most. Wealth is partly math, mostly behavior, and always context. It is not an engineering problem with a guaranteed output. It is a long conversation with uncertainty, during which your habits will either compound or betray you. An algorithm can lend you habits. It cannot give you conviction. That part you must write down in your own words and prove under pressure. So ask the questions that matter. Are you using the machine because it aligns with the philosophy you chose with clear eyes, or because it lets you avoid thinking until thinking is required? Do you understand the trade you've made? Efficiency for individuality, standardization for nuance, convenience for agency. Are you prepared to live with the average when the average feels cruel, because that is often when it is earned? If the answers are yes, then the algorithm is a quiet ally. If the answers are no, then it is an elegant way to drift. Every revolution tells a comforting story. This time is different. The promise here is that prosperity can be automated for the crowd. History offers a more humble lesson. Systems improve, frictions fall, access expands, and yet the fundamentals remain. Markets reward patience and punish illusions. Fees matter. Behavior matters more. Incentives shape outcomes. And when the lights flicker, the people who survive are the ones who knew what they owned and why, who set their rules before the storm, and who refused to outsource the final responsibility for their own decisions. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.